Hey, today we are going to discuss about interest expense that you can itemize on Schedule A. So we have these two types of interest, that is mortgage interest and investment interest expense. So you all know that from the gross income we make adjustments and we arrive at adjustment gross income. From that we deduct standard deduction or itemized deduction, whichever is higher. So if the itemized deductions are higher, the taxpayer generally avails this. In itemized deductions we have this interest expense. So we have two types of interest expense, that is first one is mortgage interest and so the second one is investment interest expense. The first one we are going to discuss right now, mortgage interest. Suppose if you are taking any loan for the for the purchase of a house or to renovate it, in that case the interest that you are paying you can itemize it on Schedule A. Here in this, the mortgage insurance premiums that you are paying, they are not allowed. So the first one is like interest on loan, either you are taking that for buying the house or building on yourself, and if you are taking that loan either to improve it, in that case interest that you're paying is allowed as deduction. And if you are taking any other, for any other purpose you are taking loan, then interest is not allowed. So what does that mean? Suppose in the case of home equity loan where the value is like 500k, the mortgage on that is 300k, on the balance 200k the bank is providing like a 150k loan. So you are taking that loan for the purpose of for your personal use, like investment, for making any investment or medical expenses like that. In that case, by keeping home as collateral you are taking that loan. If you are paying interest on that, it is not allowed. So only for the purpose of acquiring a property and making some additions to it by building, renovating, in that case the interest paid on that is, in that case only the interest is allowed. So second, we have the most important thing, the points. So points is like prepaid interest on mortgage. One point is like 1% of the loan amount. Suppose if you are taking suppose you are paying like $1 lakh down payment, and you go for a $2 lakh home loan. So points is calculated always on the loan amount, like $2 lakh. So let me just take an example. Here we have the home is like 3 lakhs, you're making down payment $60,000, and you're going for loan like mortgage 2.4 lakhs. Points is like a percentage of a loan. So what happens is that you go to a Wells Fargo bank, you ask them, hey buddy, I want to purchase a home, I want some loan. He says that okay, you are paying 60,000 down payment and the loan is like 2.4 lakhs, so just pay me 2% of the loan amount, that is like 4,800. Sorry, that is like 4,800. Okay, this is wrong. So if you pay me 2% of the loan amount, okay, right now the interest rate is 6%, but if you pay the 2% of that, I will reduce your interest rate, okay, so that the EMI also gets reduced. So the main thing is that, so bank is getting like 60,000 right now, so bank wants more money, so immediate cash payments it wants more. So in that case it asks like, hey buddy, pay some percentage like 2 points or 3 points like that, so that we will reduce your EMI, interest rates will be lower, it will be beneficial to you. So the taxpayer agrees. In that case, how the points are like taxed to him, how he can take advantage of that. So what is the advantage for Wells Fargo means like immediate cash payments will be there to the bank, and in case if interest rates drops in the future, like banks will still get benefited. So right now the interest rates are like 6%, when so he is offering like 5.5%, when interest rates drops further, like still the banks are still get benefited. So this is how that works. So the points that buyer is paying right now, how are they like benefited to the taxpayer? That means, so the points that you're paying in case of a main home, that is fully allowed as itemized deduction or your Schedule A, that is with respect to the main home only. But when in case of second home or refinancing, or in case the property is a investment property, the interest that you're paying, sorry, the points that you're paying is apportioned over the loan period. So what does that mean? Suppose the loan term is like 10 years, the points 2% of the 2%, 2 points is like 2% of the loan that you're paying is like $1,000, it has to be apportioned during that 10 years, like $100 up to the 10 years. Like every year you can itemize $100 on your schedule A in your 1040. So this is all. That means in case of any other situation where you're paying points, they are not allowed. Only in the case of main home, they are fully allowed in the year that you are paying. Okay. And in case of second home or refinancing or investment property, in these three scenarios, they are apportioned over the loan term, and you will be getting the like every year you will be getting that benefit. Again, is itemized under schedule A. In case of any other, we don't allow the points. So this is all about mortgage interest. So let us move to the second one. So investment interest expense. Suppose if you're making any investments, you'll be generally getting that dividends and interest income. So if you want to invest, you can get a if you want to make any investments and get interest or dividend income, you can get a loans. Like you can arrange some loan amounts, and that is investment interest expense is always limited to the interest income. So what does that mean? If you're getting any interest income that is like $10,000, up to $10,000 expense is only allowed, and the balance you can just carry forward it. Okay. And in case of individuals, estates and trusts, like these three guys are required to file 4952 form to figure out this investment interest expense calculations and how they are like calculated. This 4952 form is required, and this form is not required in case where the income is greater than the expenses and where there is no prior year carry forward. So what does it mean? IRS says that if your expense is more than your income, see, if your expense is more than your income, so just file the form 4952 so that I can know like what are the expenses that you are incurring and your everything details. So 5952, sorry, form 4952 is not required if your income is greater than expenses, and if there is no prior year carry forward, you are not required to file this 4952. So that's it. So how do IRS knows means generally, like if you get a loan, like loan agreement is IRS will verify the loan agreement and the bank statement of yours, getting that paying interest and making any amounts to the brokerage account. The bank statement generally helps you for the IRS. And if you are making any investments in the for getting any interest and dividend, the brokerage account in which you are depositing money, that would be verified by the IRS. So even in the case of if you are applying for loan agreement, it asks the purpose, like why are you getting the loan, personal loan, vehicle loan, like that. The purpose of the loan is clearly mentioned in that, so you can just give to the IRS and prove that you got the loan for the specific purpose. And so like that, that's how it works. Thank you.